That man there is Dr. Michael Burry, the real-life investor portrayed by Christian Bale in the film adaptation of Michael Lewis's book, The Big Short. Greater than, we had a huge bet for us, and I was very confident in the outcome. You must have been fairly certain that this thing was going to blow up. Both the book and the movie are excellent. In order to demonstrate how this exceptionally intelligent young man foresaw the impending financial crisis years before it actually materialized, I want to delve a little bit deeper into the specifics in this video, going over some of the topics that the film skips over. In the process, he made about $800 million. Dr. Michael Burry was the first to see that there was a big problem with the expanding subprime mortgage sector. I looked at these pools, read the prospectuses, and called up the prospectuses. I could see the credit standards in these pools degrading. Burry calculated that if only a small portion of the risky loans failed, these mortgage-backed securities would lose all of their value. We essentially purchased $8.4 billion worth of credit default swaps. You made a lot of money then, made a huge profit. Were your customers appreciative? Greater than. It's amazing there, too. Investors who profited from this to the tune of tens of millions are still quite unhappy. If you're like me, you were undoubtedly in complete awe the first time you saw The Big Short. However, it's likely that you left the film with a partial comprehension of all the technical terms: credit default swaps, ratings agencies, mortgage-backed securities, and so forth. Well, in this video, we're going to go through literally the whole thing. And it starts with the fundamental building block of what became the 2008 financial crisis, which is the mortgage-backed security, or the mortgage bond. Think about a single mortgage first. Say you needed $1 million loan to go and buy your dream house. Now, traditionally, the bank loans you the $1 million or however much you need, and you have to pay that back over time, plus your interest payments. Now, all that money goes directly to the bank, and if you stop paying, the bank takes your house off you and sells it. Although hopefully that doesn't happen. But this process of giving out loans to homebuyers obviously happens over and over and over again. Thousands and thousands and thousands of times, because, well, quite simply, there are thousands and thousands of us out there buying homes that we QAON actually afford outright. So long story short, lots of banks out there creating lots of mortgages. But what happens next is kind of interesting. This is where investment banks come in. So these banks will buy the mortgages off of the smaller commercial banks, and they put all the loans together under a special purpose entity. Thus, all of these mortgages are held by one business, which also gets all of the mortgage payments. When a result in terms of investments, you now have a unique business that receives a specific amount of cash flow annually when borrowers repay these mortgages. Suddenly, this appears to be something that people could want to invest in. As a result, the investment bank will split the company up into numerous small shares, which investors can purchase to get a percentage of the company's yearly cash flow. This security is backed by a mortgage. It's a stake in the special purpose business that owns these gradually repaid mortgages. However, some of these mortgage holders will regrettably not continue the voyage. Isn't that right? A few of them will sell their home and make early mortgage payments. That is not an issue. However, some will default, and others will find it difficult to make their loan payments. That's clearly bad, because it will lower the return for investors who buy shares in the special purpose company. However, what percentage of people are likely to default, which would reduce your returns? Many? A few. It's hard to tell for sure, though. Investment banks therefore take things a step further. After grouping the mortgages into this special company and dividing it up into shares, they will then group those shares into different tranches or slices. So say the shares of this entity get grouped into 3 tranches, one called senior, one called mezzanine, and one called equity. Now in this arrangement, shareholders agree that if some homeowners default, the equity tranche will be the first to take on those defaults. Then if there's enough defaults to wipe out the entire equity tranche, then the mezzanine tranche will start taking on defaults. And then finally, If there's enough defaults to wipe out even the mezzanine tranche, then the senior tranche will start taking on defaults. Now, because of this risk structure, the riskier equity shares will pay a higher yield to investors, and obviously, the senior tranche will have the lowest yield because it's the least risky. So there's something there for everyone, and they are the basic principles behind what's called a collateralized mortgage obligation, a mortgage-backed security that is split up into tranches according to different risk profiles is called a collateralized mortgage obligation, or CMO. Additionally, a collateralized debt obligation, or CDO, is a common theme in the film. Although it can also cover credit card loans, auto loans, and even tranches of other mortgage-backed securities, it is essentially the same thing. The CDOs they discuss in the film are actually just combining all of the bad, undesired tranches of various mortgage-backed securities into one package. The argument there is that, of course, they contained enough garbage from various sources to give the impression that they were diversified, but in fact, they were just diversified throughout a wide range of dangerous things. In the end, though, as an investor in mortgage-backed securities, you would hope that the small commercial banks that initiated this entire process were only lending money to people who had a very high probability of being able to repay their mortgages regardless of the tranche you purchase. Correct? For now, let's put that idea on wait. Let us start by discussing how these securities initially created such a significant problem and how Michael Burry himself identified the problem. Therefore, the securitization of mortgages started a long time ago in the 1970s, but it was untamed till President Reagan signed what was called the Secondary Mortgage Market Enhancement Act in 1984. That things started to get interesting. And the reason things started getting interesting is because the act allowed financial institutions such as insurance companies and even pension funds to buy mortgage-backed securities. Naturally, these securities became very popular with institutional investors because of their high yields, but seemingly low risk because at the end of the day, there were just a bunch of diversified mortgages, respectable mortgages, right? But because the securitization of mortgages was now getting popular for commercial banks, their product, which is the mortgage, was now in really high demand. But from the other direction, investors wanted to buy mortgage-backed securities. And because a mortgage was suddenly so easy to sell onto an investment bank, this gave the commercial banks the incentive to write as many mortgages as they could. They could simply turn around and sell the mortgages they issued to Wall Street, regardless of how many they wrote. They might absolve themselves of the responsibility and grab the easy money. But as you might guess, banks began to get creative in order to provide home loans to an increasing number of people as a result of this arrangement and the appeal of the great American dream of home ownership. However, a tool was required in order to fulfill this dream, something that would significantly lower the cost of home loans for people who lack the resources, income, or credit to qualify for one. Let's go back to 1982 once more. For the first time, adjustable rate mortgages were made legal under the Depository Institutions Act. These adjustable rate mortgages, or teaser rate mortgages, would in various forms be the primary mortgage product at the heart of the collapse of our economy 2.5 decades later. Greater than. Enter the adjustable rate mortgage. This is the mortgage product that typically starts with a fixed interest rate for a certain period of time, but then reverts to the going variable rate once that teaser period is over. It's a mortgage product that has its pros and its cons, but one of its major cons is that it sucks people in with that teaser rate and then can end up trapping people into a mortgage they can't actually afford when the teaser rate is over. But interestingly, adjustable rate mortgages did not take off immediately. They didn't truly take off until the market for affordability products in the mortgage space was energized by new regulatory and legislative reforms in the 1990s and early 2000s. In fact, Michael Burry first noticed the emergence of this circumstance in the early 2000s. Commercial banks were unintentionally encouraged to create a large number of poor loans by this system of encapsulating mortgages into investment products that, investors could purchase. Thanks to a variety of creative loan options, these banks were now able to lend money to almost anybody, regardless of their income, financial situation, or background. And it didn't matter because it would all just be sold on to investors. And the hard pill to swallow was that the government didn't really care, either because it meant more Americans were getting what they wanted, a home. As you might expect, this system caused mortgages to continue to get more and more risky. But then, just to add fuel on the fire, from 2001 to 2003, the Federal Reserve lowered interest rates from 6% to 1%. So not only were the mortgage products getting more wild, the Federal Reserve was making borrowing easier and easier. Interest payments were going down, borrowing capacities were going up. And the stripper scene in which she tells Steve Carell's character that she has 5 houses and a condo is a well-known example of this in the film. Thus, another significant increase in home loans results from this reduction in interest rates. Additionally, it raises home prices because everyone is borrowing and purchasing. However, this was plainly not an issue at the time because people could just refinance their homes as long as home prices continued to climb. A new loan with a reduced interest rate was available to them to replace their previous one. The value of your property has increased. Now that you have more equity, you can use it to make a down payment on a new house even though your mortgage debt has increased. And don't worry about that new mortgage because you've locked in a great teaser rate. So you don't have to worry about that debt for ages. Plus, your new house will probably be worth a lot more than anyway, so we can just refinance that one. At this point, you now have banks offering loans to anyone that wants one. People borrowing in huge amounts because it seems like borrowed money is basically free, and they all had the mentality that it's probably smart to get in now because your house will likely be worth a lot more in a few years' time. But this whole line of thinking completely relies on one thing, and that is house prices continuing to rise. Greater than. It was a positive feedback loop with the full blessings of the U.S. government. In fact, amidst early fears that the housing market was getting ahead of itself in 2003, Fed Chairman Alan Greenspan assured everyone that national bubbles in real estate simply do not happen. I questioned whether common sense should forbid applying precedent to the unprecedented as I researched the housing trends in the country at the time. Greater than. That being said, Michael Burry got to work. After reading the SEC filings, he began to examine the contents of these mortgage-backed securities critically. There was a real problem. People who shouldn't have been able to get large mortgages were getting them. Due to the optimistic state of the market, investors were unaware of the risk associated with the securities they owned. However, what was Burry's turning point? At what moment did he start to feel that everything was about to collapse? In this interview, he states that the advent of the interest-only adjustable rate mortgage was the turning point for him. Mortgage rates leveled out in 2003. As a result, banks decided to provide interest-only adjustable rate mortgages. In other words, you don't repay any of the loan itself in order to encourage further loans, which further increased demand and hence housing values. In 2003, lenders selected a 1920 tool for subprime borrowers. The interest-only adjustable rate mortgage lenders, by implementing a mortgage product they had long avoided, showed for all to see. They were interested in growth more than they were interested in maintaining credit re's credit standards. They were no longer interested in checking excess credit risk at the door. By fall of 2004, I noted for my investors that Countrywide Financial, a very large national mortgage lender, reported subprime mortgage originations up 13.58% year-over-year. Despite a 24% decline in overall loan originations, evidence was therefore manifest. Banks were chasing bad credits, inclusive of housing speculators. Burry was therefore very certain that this system would fail at this point. Burry was certain that banks would continue to push the envelope as far as they could after the interest-only adjustable rate mortgage entered the market, and they did. To his astonishment, the banks produced the negative amortizing adjustable rate subprime mortgage, the most speculative loan type ever. What does that signify? In other words, it gave borrowers who shouldn't have been granted loans the choice to make no monthly payments at all. Instead, a mortgage with no payments needed would be obtained by simply adding the missing monthly interest payment to the principal loan amount. And what sort of borrower do you think that attracted? Yes, one with absolutely no income and absolutely no idea. And Burry has said in the past that this was it for him. He realized the only way these loans would go bad is if housing prices continue to strongly appreciate without fail. He said himself that this type of loan would not exist unless everyone believed that house prices would only go up. And in his own words, home price appreciation was not long for this world precisely because these mortgage products existed. Greater than, I saw absolutely no chance of home prices going sideways or stabilizing for any significant length of time. Once home price appreciation was no longer a given, these new types of mortgages would simply disappear. Home prices starved of peak credit would fall and fall steeply as mortgage and refinancing options crumbled away. The crisis, in my view, would start in 2007, by which time teaser rate periods on the vast majority of these new types of mortgages would expire or reset for a population of homeowners trapped in mortgages they could no longer afford. And on the way down, housing would take consumer spending, jobs, everything with it. A positive feedback loop of a very damaging variety was set up. And with that realization, there was only one thing for it: bet against the housing market. And that's where the name The Big Short comes from. And to make this bet, he used a financial instrument called a credit default swap. I specifically wanted to purchase credit default swaps on subordinated tranches of BAC securities for subprime residential mortgages. A credit default swap can be compared to purchasing insurance in the same manner that you would purchase insurance in the event that your home burns down. Yes, this is where things become a little more complicated. Burry purchased insurance that would pay him if the value of the mortgage-backed securities declined. The catch is that he was able to obtain this insurance without actually having any mortgage-backed securities. In a credit default swap, Michael Burry, the buyer of the swap contract, pays Deutsche Bank, the seller, until the contract's maturity date. In exchange, the seller consents that Deutsche Bank will reimburse Burr for the value of the mortgage-backed securities as well as for all interest payments that would have been made between that point and the securities' maturity date in the event that the subordinated, lower-quality tranches of some of these mortgage-backed securities failed. In short, if all these mortgages began to default, Michael Burr was going to go bankrupt. Naturally, they did. The cost of homes dropped. People were unable to remortgage. People were overtaken by their debts. Default rates increased dramatically. Naturally, this had an impact on those who owned mortgage-backed securities. The securities backed by mortgages were completely destroyed. The entire financial system went into panic as even the safest AAA tranches were impacted. People who didn't purchase insurance lost a lot of money. However, Michael Burry made a lot of money. Everyone frantically attempted to get this insurance to shield themselves from MBS losses, and as the system collapsed, the value of his credit default swaps surged. In the end, Burry made over $100 million in personal profit, while his investors made over $700 million. From its founding on November 1, 2000 to June 2008, Scion Capital reported returns of 489.34% net of fees and expenditures. In contrast, the S&P returned slightly less than 3% throughout the same time period, including dividends. And that's how he accomplished it, all in all. In this way, Michael Burry anticipated the housing collapse and made money off of it. Many thanks for viewing. If you liked the video or found it helpful, kindly hit the like button. Folks, I really appreciate you looking into that. Thank you. However, I'll see you guys in the upcoming video.